Value Investing, From Graham to Buffett and Beyond, by Bruce C. and Greenwald, Judd Kahn, Paul D. Sonkin, and Michael Van Biema. Picture this. It's 1973. America's in a funk. The stock market? Absolutely tanking. And here's the wild part. The Washington Post, one of the most respected newspapers in the entire country, is basically on clearance. We're talking about the whole company, the legendary newspaper, television stations, valuable real estate, all of it. Market price? A measly $80 million. Now there's this one guy watching all this unfold. Years later, he'd become the most famous investor on the planet. And he spotted something everyone else completely missed. If you broke up the company and sold it piece by piece, you'd walk away with $400 million. Maybe even $500 million. The market was literally offering him $1 for 20 cents. While everyone else was losing their minds and running for the hills, this guy, Warren Buffett, just calmly started buying shares. He wasn't taking wild guesses. He wasn't gambling. He was using a secret, a powerful principle that's created more wealth than maybe any other single idea in financial history. Want to know that secret? It's the beating heart of the book we're diving into today, Value Investing, From Graham to Buffett and Beyond. This isn't just another how to pick stocks book. This is the modern playbook for a discipline created by the legendary Benjamin Graham, the guy who taught Warren Buffett everything he knows. It's a way of thinking that transforms the chaos of the stock market into a field of golden opportunities. Here's my promise. By the time we're done, you'll understand the 3 core pillars of this powerful philosophy. You'll learn to see the market not as some terrifying, unpredictable monster, but as a moody business partner who, on his worst days, hands you incredible bargains. You'll grasp the difference between price and value, the single most important distinction in all of investing. And honestly, this isn't just about money. It's about developing a mindset of patience, discipline, and independent thinking that'll serve you in every corner of your life. So let's jump in. To really get value investing, you need to meet someone. A pretty peculiar character, actually. Benjamin Graham, the father of this whole philosophy, gave him a name, Mr. Market. Imagine Mr. Market is your business partner. Every single day, without fail, he knocks on your door with an offer to either buy your shares or sell you his. Here's the catch, though. Mr. Market is completely manic-depressive. Some days, he's flying high. He sees nothing but sunshine and rainbows, and he'll throw outrageously high prices at you for your shares. Other days, he's doom and gloom, convinced the world's ending, ready to sell you his shares for absolute pennies on the dollar. The beautiful thing? He doesn't mind being ignored. He'll just show up tomorrow with a brand new price. Most people take their emotional cues from Mr. Market. When he's euphoric, they get excited and buy. When he's terrified, they panic and sell. They let his wild emotions drive their decisions. But the value investor? They do the exact opposite. They understand that Mr. Market's prices are just his mood swings, and they have basically nothing to do with what the business is actually worth. The value investor's job is beautifully simple. Take advantage of Mr. Market, don't be guided by him. Sell to him when he's giddy. Buy from him when he's miserable. This is the foundation of value investing. It rests on this revolutionary concept Graham introduced to a world treating the stock market like a casino. He said a stock isn't a lottery ticket. It's not just a blip on a screen. A stock is a small piece of ownership in a real, living, breathing business. And because it's a business, it has intrinsic value, a true underlying worth that's completely separate from its daily stock price. The whole game, the entire discipline, is figuring out that intrinsic value and then waiting with enormous patience for Mr. Market to offer you a price significantly below it. That gap, the space between intrinsic value and what you actually pay, Graham called the most important phrase in investing, the margin of safety. It's your cushion against bad luck, judgment errors, and Mr. Market's wild mood swings. It's what makes investing both safe and profitable. Buying $1 for 95 cents? That's risky. But buying $1 for 50 cents? That's where the magic happens. So if the secret is calculating intrinsic value and buying with a margin of safety, two questions naturally pop up. First, where do you find these bargains? And second, how do you actually calculate this intrinsic value? Let's tackle the first question. Where are these hidden gems? The book puts it perfectly. You fish where the fish are. You don't hunt for bargains in the same spots as everyone else. You don't look for treasures in the middle of a packed auction house. Value is almost always hiding in the places other people are ignoring, avoiding, or actively fleeing from. Why do these opportunities even exist? The book explains it's because of powerful, predictable biases affecting almost every investor. There are institutional biases. Massive investment funds managing billions have rules preventing them from buying certain stocks. Maybe a company's too small. A $5 billion fund can't be bothered with a $50 million company. It's just not worth the paperwork. So small companies get ignored and undervalued. Then there are career preservation biases. Most professional money managers are employees, and the safest way to keep your job isn't being a hero. It's looking like everyone else. Nobody gets fired for buying IBM and watching it drop. But buy some weird, unknown, ugly duckling stock that tanks, everyone remembers you picked that disaster. So managers huddle together, buying the same popular, glamorous stocks. This herd mentality pushes winner stock prices to absurd heights and drives loser stock prices even lower, creating opportunities for anyone willing to stand apart. Finally, there are psychological biases living inside all of us. We get overly excited by recent good news and overly depressed by recent bad news. We assume a fast-growing company will grow fast forever, and a struggling company will stay struggling forever. Value investors know that one of the most powerful forces in business, like in life, is reversion to the mean. High flyers eventually come back to earth. The downtrodden often find their footing again. Horace wrote it 2,000 years ago, "Many shall be restored that now are fallen, and many shall fall that now are in honor." That's the value investor's creed. So you hunt in unpopular places. Tiny companies, boring industries, companies fresh off bad news, spin-offs from larger corporations that big funds dump without even looking, even companies in bankruptcy. You're searching for gems in the trash heap. But finding a cheap stock is just the beginning. The real work is figuring out if it's a genuine bargain or just trash. Which brings us to the second crucial question: how do you calculate intrinsic value? Most of Wall Street tries answering this by predicting the future. They use something called discounted cash flow analysis, forecasting a company's profits for the next 10-20 years, then crunching them into a single number. The authors of value investing argue this is a fool's game. It's like navigating a ship by staring at a star that might not even exist. The further you try predicting, the more your beautiful, precise calculations become pure fantasy. A tiny tweak to your growth rate assumption 10 years out can massively swing your valuation today. The Graham and Dodd approach, updated in this book, is far more grounded. It's a three-step process, moving from the most certain, reliable information to the least. Think of it like building a house. You start with a solid foundation, build the structure, and only at the very end consider adding a fancy, speculative rooftop deck. Step 1. The foundation is asset value. Before worrying about profits or growth, you ask a simple question: what's the company's stuff actually worth? You start with the balance sheet, going through it line by line. Cash is cash. That's easy. But what about the factories, land, equipment? Here's where critical judgment comes in. Is this business in a dying industry? If so, its assets are only worth what you'd get selling them off in liquidation, basically scrap value. But if the industry's viable, the assets should be valued at their reproduction cost. This is powerful. It's not what the company originally paid for its factory. It's what would it cost a competitor today to build a similar factory from scratch. This gives you a hard, tangible floor for the company's value. In a competitive market, a company shouldn't trade long below the cost of reproducing its assets. If it did, nobody would ever build new factories. They'd just buy existing companies on the cheap. Benjamin Graham loved this approach so much, he took it to extremes. He looked for companies he called net nets, companies trading for less than their current assets, like cash and inventory, minus all liabilities. Basically, you'd get the business, the factories, the brand, everything, for free. Those are nearly impossible to find today, but the principle remains. Start with what you can touch. Step 2, the main structure of the house, is earnings power value, or EPV. This is where we think about profits, but with crucial discipline. We're not guessing about the future. We're calculating the company's value based on its current, sustainable earnings, assuming zero growth. The formula's simple. EPV equals the company's adjusted earnings divided by its cost of capital. Let me break that down. Adjusted earnings means taking reported earnings and cleaning them up, smoothing out bumps from business cycles, accounting for any accounting tricks. You're finding a realistic number for the cash the business can generate in a normal year, year after year. Then you divide by the cost of capital, just the return investors demand for putting their money into a business like this. If a business generates $1 million in sustainable earnings and investors demand a 10% return, its earnings power value is $10 million. Simple as that. Now here's where the true genius reveals itself. You compare the two values you just calculated, asset value and earnings power value. 3 possibilities emerge. Case 1. Earnings power value is much lower than asset value. Big red flag. The company has valuable assets, but management's failing to generate decent profits from them. The business is being mismanaged. For aggressive investors, this might be an opportunity to buy and force change. For most, it's a warning sign. Case 2. Asset value and earnings power value are roughly equal. This is what you'd expect for most companies in competitive industries. It tells you the company's earning a normal, fair return on its assets. Solid business, but nothing special. And case 3, the one that gets every value investor's heart racing, earnings power value is significantly higher than asset value. What does this mean? The company possesses a secret weapon, something allowing it to earn abnormally high profits on its tangible assets. That special something is what Warren Buffett famously calls a franchise, or an economic moat. This is a durable competitive advantage protecting the business from competition, like a deep moat filled with crocodiles protects a castle. Without a moat, competitors see your high profits and swarm in, building their own factories, copying your products, driving down prices until all excess profit vanishes. The book shows this with a hypothetical toaster company. Once it started making great money, competitors rushed in, and soon enough, profits returned to normal. Even a powerful brand like Mercedes-Benz couldn't sustain high profits because competitors like BMW and Lexus could enter the luxury car market and compete equally. A true franchise, a real moat, is rare. The book identifies only a few sources. First, a company might have a unique cost advantage, maybe a patent or secret process, letting it make things far cheaper than anyone else. Second, more common, is customer captivity. This happens a few ways. From habit. Think how hard it'd be to get a lifelong Coca-Cola drinker to switch brands. From high switching costs. Once your whole company's trained on Microsoft Windows, the cost and pain of switching operating systems is enormous. Or from high search costs. Most people don't shop around for new home insurance every year because it's complicated and annoying. The most powerful moat of all combines customer preference with economies of scale. When a company dominates a market, like Intel with microprocessors, it can spend more on research and development than all competitors combined, yet its R&D cost per chip is lower because it sells so many more. This creates a virtuous cycle almost impossible for competitors to break. A company with a deep, wide moat is incredible. The difference between its high earnings power value and lower asset value is the franchise's value. This brings us to the third and final valuation step, the speculative rooftop deck, the value of growth. This is the most dangerous part of investing, because it's where dreams and fantasies live. Wall Street loves growth, but the hard truth, the book argues, is most growth creates zero value for shareholders. How's that possible? Because growth isn't free. To sell more, you usually need more. More factories, more inventory, more employees, all requiring more capital, more investment. For a normal company without a moat, the return it earns on new investment just covers the cost of capital required. All new profits get eaten up paying for growth itself. Existing owners are left with nothing. The only growth creating shareholder value is growth within the franchise. When a company with a strong moat can reinvest profits at a high rate of return, greater than its cost of capital. Coca-Cola expanding into a new country, or Microsoft selling a new Office version to its captive user base, that's valuable growth. But when that same company tries expanding into a business where it has no competitive advantage, it's just as likely to destroy value as create it. So the complete Graham and Dodd valuation framework is: first, build your foundation on the rock-solid value of the company's assets. That's your first and most reliable intrinsic value estimate. Second, calculate earnings power value, the value of the current business as a sustainable no-growth enterprise. If this exceeds asset value, you've likely found a company with a franchise. The difference between the two is that franchise's value. Only then, if and only if, you've identified a durable franchise, do you dare place a value on its future growth. For the most conservative value investors, the best strategy is paying only for assets or current earnings power, getting growth for free. That provides the ultimate margin of safety. This three-part approach forces discipline. It separates what's known and reliable, the value of assets today, from what's speculative, the value of growth tomorrow. It grounds you in reality. The rest of the book beautifully illustrates these principles through stories of 8 master investors, each with unique styles but all united by this core philosophy. There's Walter Schloss, who worked for Ben Graham himself. His approach is the discipline's purest form. Keep it simple, keep it cheap. He and his son Edwin ran a portfolio of 100 or more stocks, each bought at a discount to asset value. They didn't talk to management, just read financial statements. Their philosophy? If you buy a basket of cheap stocks, you don't need to know which will work out. The ones that do more than make up for the ones that don't. Then there's Glenn Greenberg, taking the exact opposite portfolio approach. He follows Mark Twain's advice: put all your eggs in one basket and watch that basket. His firm, Chieftain Capital, typically owns only 8 to 10 stocks. But before buying, they investigate a company so thoroughly they know it inside and out. They're hunting those rare, wonderful businesses with deep moats they can buy at reasonable prices and hold for years. They call these 2-inch putts investments with high success probability and minimal risk. There's Mario Gabelli, who refined intrinsic value into what he calls private market value, or PMV. He asks, what would a smart, informed industrialist, someone who knows the industry inside and out, pay to buy this entire company? Then he looks for a catalyst, an event like a merger, restructuring, or regulation change that'll unlock that value and close the gap between public stock price and private market value. And of course, Warren Buffett, representing the discipline's evolution. Influenced by his partner Charlie Munger, Buffett moved away from Graham's cigar butt approach, buying terrible businesses just because they were dirt cheap, to his famous mantra of buying wonderful companies at fair prices rather than fair companies at wonderful prices. For Buffett, business quality and long-term franchise value became paramount. Investing for him is simply allocating capital to the best possible businesses. Each of these masters, Seth Klarman with his obsessive focus on risk and finding motivated sellers, Michael Price, the activist buying large stakes in companies and forcing management to enhance shareholder value, demonstrates a different facet of the same gem. The core idea stays constant. Know what a business is worth, pay way less for it, have the discipline and patience to wait for the world to recognize its value. It's a philosophy that's simple, but definitely not easy. It requires a temperament immune to crowd madness, deep curiosity about how businesses work, an unwavering belief that in the long run, value always prevails. So what do we take away from all this? When you first encounter these value investing ideas, they can feel a bit old-fashioned. In a world obsessed with speed, technology, and explosive growth, a philosophy built on patience, tangible assets, and skepticism about the future can seem out of place, but I think that's precisely why it's more important today than ever. The single most powerful lesson in this book isn't some formula for calculating P/E ratios. It's about temperament. It's a way of being in the world. It's about the profound strength that comes from thinking for yourself. We live in an age of noise. Every day we're bombarded with opinions, hot tips, urgent calls to action. The story of Mr. Market is more than a stock market analogy. It's a metaphor for modern life. There's always a crowd telling you what to think, what to want, what to fear. Value investing is, at its core, a discipline of intellectual independence. It's the courage to stand apart from the crowd, trust your own analysis, and act on your own judgment, even when, especially when, everyone else thinks you're crazy. The second thing that strikes me is how this book demystifies the world of finance. It teaches you that a company isn't some abstract entity represented by a ticker symbol. It's a collection of assets and a stream of earnings. By breaking valuation into those three simple parts, assets, earnings power, and growth, it gives you a tangible, logical framework. It turns something feeling impossibly complex into a solvable puzzle. You start seeing businesses everywhere, not just on the stock exchange. You look at your local coffee shop, the software on your computer, the car you drive, and start asking the right questions. What are its assets? What's its sustainable earning power? Does it have a moat? This way of thinking is a superpower. It lets you see the economic reality underneath the surface of things. So how can you start applying this wisdom right now, even if you're not ready to invest a single dollar? First, start cultivating your own circle of competence, as Warren Buffett calls it. Don't try being an expert on everything. Pick one industry that genuinely fascinates you. Could be video games, fashion, or renewable energy. Read its trade magazines, learn its language. Understand who the major players are and what their competitive advantages are. Your goal isn't picking stocks. It's becoming truly knowledgeable about one small corner of the business world. This is how you build a foundation for sound judgment. Second, practice the mindset. Next time you hear about a company whose stock has crashed, resist thinking, "That's a disaster." Instead, ask the value investor's question. Is this an opportunity? Pull up its financial statements. Look at its balance sheet. How much cash does it have? What's its book value? Is there still a real, tangible business underneath all the bad news? You don't have to buy anything. You're just training your mind to see value where others only see fear. Finally, cultivate patience. Value investing isn't a get-rich-quick scheme. It's a get-rich-slowly and stay-rich-surely scheme. It's about playing the long game. In a world rewarding instant gratification, the ability to wait for the right pitch is an incredible advantage. That was a summary of value investing, from Graham to Buffett and beyond. We've explored the core principles today, but I need to be honest. A summary is like looking at a map of a beautiful country. It can show you major cities and highest mountains, but it can never replace the experience of actually walking the trails, meeting the people, discovering hidden valleys yourself. The real magic of a book like this happens in quiet reading moments, when a particular story or simple phrase connects with you unexpectedly. This summary is your map, helping you decide if this journey's one you want to take. If anything we've talked about sparked your curiosity, I urge you to grab a copy. Reading it isn't just about learning. It's an experience that can fundamentally change how you think about business, money, and maybe even the world. Also, if you found this journey valuable, it'd mean the world if you'd hit that like button and subscribe to the channel. That way, you won't miss our next exploration into another life-changing book. Let's keep learning and growing together.